In this video, I will be discussing the excess earnings approach. The excess earnings approach only appears in your book in a call-out box. If you are like I was in college, you don't read the call-out boxes. So I'm pointing this one out to you because it's important. The excess earnings approach estimates the value of goodwill by determining how much a company is expected to outperform its peers and discounting that excess future performance back to a single value in today's dollars. To do this, we must first identify a benchmark of what is normal, and then apply that benchmark to the company we are evaluating. We will put this normal value aside and then determine what we are actually expecting in terms of future earnings by our target company. We will then compare the two. To the extent that what we expect earnings to be is greater than earnings of a target company if they were just normal, we have excess earnings. We will then take our excess earnings and make some assumptions about them. How long do we expect them to persist? Will the target company be able to outperform normal forever or just a couple years? We will also need to select a discount rate for our present value calculation. The larger the discount rate, the more conservative our estimate of goodwill will be. Ultimately, our goal is to determine what we would be willing to pay for the target company. Recall that we'd be willing to pay for the value of the net assets plus future earnings potential, which we will be capturing in our estimate of goodwill. Let's look at the example. In this example, we have Plantation Homes, who is considering the acquisition of Condominiums, Inc. in early 2015. To assess the amount it might be willing to pay, Plantation Homes makes the following computations and assumptions. First, Condominiums, Inc. has identifiable assets with fair value of $15 million and liabilities of $8.8 million. The assets include office equipment with fair value approximating book value, buildings with a fair value 30% higher than book value, and land with a fair value 75% higher than book value. The remaining lives of the assets are deemed to be approximately equal to those used by Condominiums, Inc. B. Condominiums, Inc. prepares pre-tax incomes for the years 2012 through 2014 were $1.2 million, $1.5 million, and $950,000 respectively. Plantation Homes believes that an average of these earnings represents a fair estimate of the annual earnings for the indefinite future. However, it may need to consider adjustments to the items listed below that are included in pre-tax earnings. Those items are down here. We have some depreciation numbers, a non-recurring loss, and some sales commissions. Then finally, in item C, it tells us that the normal rate of return on net assets for the industry is 15%. So what are we going to do? Assume further that Plantation Homes feels it must earn 25% return on its investment and that goodwill is determined by capitalizing excess earnings. Based on these assumptions, calculate a reasonable offering price for Condominiums, Inc. Indicate how much of the price consists of goodwill and ignore tax effects. Okay, so we are going to apply our excess earnings approach. So step one, we need to figure out what our benchmark rate is. And so they told us that the normal rate of return on net assets is 15% for the industry. Now, remember, we can use any benchmark that we think makes sense, but in this case, they're telling us normal rate of return on net assets. So our normal rate of return is going to be 15%, and then we need to apply that percentage to our target company to estimate what earnings would be if our company that we're interested in is normal. So we need to know net assets, and they told us that there's a fair value of assets of $15 million and a fair value of liabilities of $8.8 million. So $15 million and $8.8 million. Our net assets is going to be the difference between the two, which means our net assets for the target company are $6.2 million. We're going to apply our 15% target rate of return, which means for a company with $6.2 million of net assets, like our target, we would expect annual earnings of $930,000. Okay, so this is what would happen if the company was just normal. Now, we're hoping they're better than normal. So let's do an analysis based on their actual performance to try to decide what we think is going to happen. So they gave us pre-tax income for 3 years and told us that they thought the average of those three years was pretty representative of this company's performance. So we're going to go back up here And item B has some income statement information. So we have our income for 2012 was $1.2 million. For 2013, it was $1.5 million. And for 2014, it was $950,000. Now, we could just take the average of these 3 years, but they told us we might need to make some adjustments, and those adjustments had to do with these items right here. So let's talk through each of them and see why we might need to take them into account. So the first one is depreciation on the buildings. So remember, if we buy the target company, we're going to have to write all of their assets and liabilities up to fair value. So when we write their buildings up to fair value, if there's an increase in value, that means that's going to result in an additional amount of property, plant, and equipment that needs to be depreciated that's not currently in their forecasted future income. Similar for equipment. So here they tell us that the office equipment has a fair value that approximates book value. So that means that when we write up our equipment, we're not actually changing the asset amount when we write it up to fair value. It's already at fair value. So that means that the amount of depreciation in these net income numbers that they gave us should be accurate. So we don't need to adjust for that. They then tell us that buildings with a fair value 30% higher than book value were brought over. So these buildings right here, they're going to be grossed up by 30% when we merge these companies, if we do that. And so that means that our income that we're expecting would actually be lower by the additional depreciation that we're going to have to record. So that means we're going to need an additional 30% of this depreciation to take out of our forecast. All right, then we have a non-recurring loss that happened only in 2014. Now, by definition, we don't expect this to happen in any year other than 2014. So if we're using 2014 to try to forecast other years, we're going to need to take this out. And so because it decreased net income, we're going to add this back. Then finally, we have sales commissions. So sales commissions are already included in our income numbers. And so we need to think about, if we merged these two companies, is there any reason sales commissions would change? And they haven't given us any reason to believe that's true. Now, it's possible that if we merged these companies, we would take all of their sales team and put them on our contracts, and that would change how we recognize sales commission. But they didn't tell us anything about that. So we don't need to make any adjustment for this one because we have no reason to believe it's going to be any different post-merger than it is currently. Okay, so we need some extra depreciation. So we're going to take that $960,000 times 30%, which gives us an extra $288,000 of depreciation, and we want to take that every year. We also said we were going to adjust for that non-recurring loss. So that only happened in 2014. And we're going to need to add that back. So let's adjust our income now. So we have our pre-tax income as they're forecasting. We think we're going to need to take some extra depreciation to depreciate that extra value of PP&E once we write it up to fair value. And we're going to have to add back any non-recurring losses because those aren't indicative of future performance. So that gives us an adjusted pre-tax income of $912,000 for the first year, $1.2 million for the second year, and $960,000 for the third year. So now we're going to take our average again. And this is the one we're going to use going forward. So we see it's a little bit lower. Had we used this one, we might have gotten an inflated value of the target company because we weren't taking into account this extra depreciation that's going to come to fruition should we go through with the deal. Okay, So now we're going to compare what we actually expect, which is the number we just calculated. That's what we think annually this company will provide in earnings. And we're going to compare that to what we think they would do if they were just a normal company. And right away we can see that we're going to have excess earnings because we think they're going to outperform normal. So we think there's going to be excess earnings of $98,667 per year. And now we have to figure out how to convert that number into an estimate of goodwill. And so they gave us a target return of 25%. We are going to use that as our discount rate. They also told us that they believe that well, they didn't give us a number of years. So they thought that this would be indicative of their performance indefinitely. And so if we believe that it's indefinitely, then we have a perpetuity. So that's $98,667 next year that we're going to outperform the market, and the year after that, 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 forever. So the great thing about a perpetuity is we don't need any fancy present value factors or tables. All we're going to do is we're going to take our amount that we believe we're going to outperform the market by each year, and we're going to divide it by our discount rate, and that gives us our estimate of goodwill, which is $394,667. Okay, so then we need to figure out our offering price. So remember, we'd be willing to pay for the assets, which were $15 million. They're going to make us take the liabilities, which are $8.8 million. And we'd also be willing to pay for goodwill, or that future earnings potential. So our offering price would be our assets less our liabilities plus that goodwill. So we think, based on these calculations, we'd be willing to pay about $6.6 million. Now, if you guys remember from fair value, we need to be a little bit careful here because we've made a lot of assumptions. This is just another estimate. So if you look up here, we're estimating that the fair value of the assets and liabilities are going to be these numbers, but we don't know that for sure. We haven't done our due diligence yet. Our normal rate of return is based on industry average, but how are we defining the industry? Who are we looking at? Did we take every firm in the industry? Did we take just our 5 biggest competitors? Where'd that come from? We also had to estimate pre-tax income. We had to guess that we're going to have 30% gross up on our depreciation. Also, why a 3-year average, right? We could have done 5 years. So we've made a lot of assumptions here, not least of which we decided that we were going to be able to outperform the market for indefinitely, for perpetuity, and that our target rate of return is 25%. So let's just take a look at a scenario where we change just these last 2 assumptions, the duration and our rate of return. So in this one, we have Plantation Homes feels that it must earn a 15% return on its investment, so that's a change from 25%, but that average excess earnings are to be capitalized for only 3 years. Based on these assumptions, calculate the reasonable offering price and indicate how much consists of goodwill. So same task. Our expected earnings doesn't change. Our normal earnings doesn't change. So that means our excess earnings also will not change. What does change is our target rate of return. So now it's going to be 15%. And we decided we were only going to outperform normal for 3 years. So that means that we now do have to mess with a present value calculation. And so I am going to do the Excel function. Our rate is the 15%. The number of payments is going to be 3 because we believe we're going to outperform the market for 3 years. Our payment is going to be a negative $98,667. The negative is just a function of how the assumptions the present value calculation makes. So to make this a positive number, we need to put in negative. And then we're going to calculate, and we get a value of goodwill that is $225,278. So we can see that that is lower than what our previous calculation of goodwill was. So this must be a more conservative estimate. Now let's take a look at our offering price we'd be willing to pay. So we'd still be willing to pay for all the assets. We still have to assume all the liabilities, but now our goodwill has decreased. So add our assets, subtract our liabilities, and add goodwill. So now we see our offering price is $6.4 million, a little bit lower. So if we were actually thinking about doing this deal, we would probably do both of these calculations. And so then we would think, okay, so if I can get this for $6.4 million, I'll probably feel pretty good about this. But I'd be willing to pay up to the 6.5, 6.6 million because I also really believe it's worth that. Now, if I had to pay 7 million, 7.2 million, now my calculations don't support that value. So I'm going to be a little bit more skeptical. I might bow out of this deal. We also turned 2 dials from here to here. We changed the discount rate and we changed the term. So I want to take a minute to look at both of those things and show you what effects they had. So we had our 25% discount rate and we had our 15% discount rate. And for duration, we had a perpetuity. And we had 3 years. So the ones we did was we did a perpetuity and 25, which got us goodwill of $394,000. And we did 15 and 3, which got us goodwill of $225,000. Now, I think it's pretty obvious that 3 years as an assumption is more conservative than a perpetuity. So we're going to expect the numbers in this column to be lower than the numbers in this column, but it's less clear what the effect is of the discount rate. So let's start with our with 25% and 3 years. So here we're going to have to do a present value calculation again. Our excess earnings, need to do our rate. So our rate is going to be 25%. Our number of payments is going to be 3 years. And our payment is going to be that excess earnings. Again, we're going to enter that as a negative number. And so we see that as predicted, the number in this column is smaller than the number in this column because assuming 3 years is a more conservative estimate than assuming forever. So now let's look at the difference between our discount rates. You can see over here that we have a smaller number for 3 years and 25% than we do for 3 years and 15%. So that means the higher the discount rate, the more conservative our estimate is being. So if that's true, that means that this cell down here should be the most aggressive of both, for both assumptions, forever and the lower discount rate. So let's double check that. So we're going to take our excess earnings of $98,667. And because it's a perpetuity, we're going to divide by our discount rate, which is 15%. And sure enough, we get the biggest number of the bunch, which is $657,000 and change. So we can see that smaller discount rate and longer period is the most aggressive, while shorter period and higher discount rate is the most conservative. This concludes our lecture on excess earnings approach. Don't forget to email questions for our discussion.